Welcome to the Stock Market Palantir. Today we are going to talk about CRCL. So, Circle Internet Group, the massive entity behind the USDC stablecoin, has had just a brutal time since its IPO back in June 2025. Its structure it's fascinating, really. It's a sort of hybrid narrow bank operating smack dab in the middle of the high-risk cryptocurrency sector. And, well, this setup has led to some extreme volatility, culminating in a devastating 76% drawdown from its 52-week highs. We are currently watching the stock just hover precariously near that $70 to $80 trading range.
And that is really the crux of the issue, isn't it? When you see a collapse of that magnitude, we have to figure out whether this repricing is rational. Meaning, the market finally figured out the fundamental flaws in their business model, or if the sheer velocity and timing of this crash are primarily dictated by technical, structural mechanisms in the trading environment itself.
I'm firmly in the camp that this is fundamentally driven. The market is finally processing the reality of the company's interest rate beta trap and the inevitable macroeconomic shift we all see coming.
See, while I agree the fundamental risks are baked into the long-term valuation, I believe the immediate sharp drop down to $70 it's overwhelmingly a technical story. It's driven by the anticipation of the IPO lockup expiry and the highly aggressive, institutionally driven hedging that is front-running that event. The technical pressure is just drowning out the fundamentals right now.
Well, we have to start with the business model because it explains why their valuation is so uniquely vulnerable. Circle isn't really a high-growth tech company in the traditional sense. They are, for all intents and purposes, a sophisticated money market fund facilitated by blockchain. Their primary revenue source, and this is critical, is the interest income derived from the fiat reserves backing USDC, specifically cash and short-dated U.S. treasuries.
So they're essentially just clipping coupons on T-bills?
Exactly. When the Federal Reserve raises rates, Circle's revenue explodes, nearly risk-free. Look at Q3 2025. They pulled in $740 million in revenue, almost all of it from that interest income. This is the very definition of the interest rate beta trap.
Okay, wait, explain that interest rate beta for the listener just simply. Sure. It just means their profitability is strictly, almost perfectly correlated with the Federal Reserve's benchmark interest rate. If the Fed funds rate is 5%, they earn an absolute fortune. If the Fed drops it to 2%, their primary revenue stream shrinks dramatically. And it does that regardless of how many people adopt crypto or use USDC. So the market is rationally pricing in this impending macroeconomic headwind, the anticipated Fed rate cuts. The smart money is looking ahead, seeing that revenue stream potentially halving in the next 2 years, and they're repricing the stock accordingly. This macro movement is the central fundamental driver of the weakness, and just to quickly clarify one point that confuses a lot of investors, the pre-IPO 1-for-150 reverse stock split.
This wasn't a sign of distress. It was a necessary strategic recapitalization designed to move the share price into a standard institutional trading range, like $20 to $50 post-split. The underlying economic value was structurally maintained.
I appreciate that context, but let's shift focus to the immediate price action. If this decline is purely about macro fundamentals, why did the stock collapse despite a massive Q3 earnings beat? They reported EPS of 64 cents against an expected 20 cents, and revenue grew 66% year over year. Excellent performance, yet the stock dropped instantly. That timing is a huge disconnect for me.
That was a classic sell the news event. The market looked right past the excellent Q3 results to the negative forward guidance.
But what specific event provides the most immediate, the most measurable negative pressure for institutional traders? It's the critical liquidity event coming up, the expiration of the IPO lockup period on Tuesday, December 2nd, 2025. This structural event means millions of shares held by founders and early investors suddenly become eligible for sale all at once. We're seeing this aggressive selling and shorting throughout November because the market is actively front-running that insider supply. They're positioning themselves for this potential supply shock. That technical positioning, driven by the structural reality of the lockup, is the engine that pushed the stock so violently into this $70 to $80 range. And if we want hard evidence of this institutional activity, just look at the FINRA off-exchange data. The off-exchange short volume ratio spiked to a massive 53.3% on November 21st. That indicates huge institutional hedging and distribution happening off the public exchanges, actively anticipating and, frankly, fueling the drop.
I understand the emphasis on the lockup. It's a clear point of uncertainty, no doubt. But let's go back to the reaction to the Q3 earnings. I would argue the selling was entirely rational. The market is a discounting mechanism. It wasn't focused on Q3 profits. It was reacting to guidance that confirmed rising operating costs and, crucially, the projected impact of future rate cuts. The decline to $70 or $80 perfectly reflects the repricing of that long-term fundamental risk. I mean, if the Federal Reserve drives rates down toward 2% by 2026, which is the bear case scenario, Circle's revenue basically halves. This aligns perfectly with the $70 bear case price targets we've seen floated. The market is rationally assessing that interest rate beta risk right now.
I acknowledge the interest rate beta is a necessary component of the long-term valuation I do. But I have to challenge whether that, distant macro threat is sufficient to explain the sheer velocity of the decline we've seen in just the last few weeks. Everyone knows rates won't stay at 5% forever, but the most immediate, concrete, and tradable threat is that December 2nd supply flood. That accelerated drop in November is the market unwinding the artificial scarcity that was imposed during the first 180 days post-listing. Institutions are playing a structural game around that specific date. To claim the speed and timing are solely due to a theoretical macro shift 6 months from now just minimizes the immediate practical impact of this looming supply shock.
That's fair. The velocity is certainly extreme.
Let's focus on the mechanics of that structural play for a second. The off-exchange short volume ratio hitting 53%. What does that high volume in these dark pools actually signify? It means that institutional distribution is occurring quietly, under the surface. Dark pools are private trading venues where large institutional holders can offload massive blocks of shares, we call this distribution, ahead of the lockup expiry. They do this away from the public lit order book so they don't, crash the price against themselves. But while they are managing their position discreetly, the cumulative effect of that massive selling still artificially accelerates the downward trend for everyone else trading on the NYSE.
That's an interesting point about institutional distribution. Though I would frame the motivation a bit differently. I agree this activity is technical and it's happening in dark pools. But it is rational risk management, not some market conspiracy. We hear the retail myth of naked shorting constantly, but the hard data, well, it often doesn't support it. When we analyze metrics like fails to deliver, the indicator of systemic settlement failure, often associated with illegal naked shorting, we see sporadic spikes, sure, but they are generally clearing. This points more toward administrative friction, not chronic, illegal activity. Furthermore, if this were truly a vulnerable short position, the exit door would be closed. But look at the actual bearish positioning. Short interest is only about 13.65% of the float, or 21.15 million shares. That's not high enough to trigger a meltdown. More critically, the days to cover is only 1.44 days. This means shorts can get out in less than 2 trading sessions. The market has sufficient liquidity to absorb this institutional distribution, and a massive short squeeze is highly improbable.
The liquidity might be sufficient for institutions to cover their shorts, yeah? But the psychological impact on the retail investor who sees half the volume vanishing into dark pools is profound. It feeds the capitulation, which only accelerates the structural slide.
And while we focus on all this near-term technical drama, we absolutely cannot forget the long-term risk and potential reward of the regulatory environment, specifically the potential passage of the Genius Act stablecoin legislation. If this passes, it is absolutely the bull case catalyst. It could potentially push the stock to $190 or more. It would formally cement Circle's status and, frankly, hobble offshore competitors like Tether. However, the immediate and painful bear case is that regulation brings massive compliance costs and mandates stricter capital requirements. If the law forces Circle to maintain deeper capital buffers, it permanently compresses their operating margins, forcing the market to value it like a low multiple regional bank, maybe 15 times earnings, That is how you fundamentally validate the $70 bear target, entirely separate from the December 2nd lockup.
That regulatory duality perfectly illuminates the profound identity crisis of this stock. On one side, you have institutional players engaged in these highly volatile hedging games. On the other, you have retail investors deep into the despair phase, the loss porn, as some call it, who fueled the run to $298 based on pure narrative, like the Genius Act passing tomorrow. Retail was fighting a structural headwind, the lockup that they simply didn't understand. The market is completely unsure if CRCL is a high-growth fintech platform deserving a high multiple, or a heavily regulated narrow bank deserving a low multiple. The wide divergence in analyst price targets from $70 to over $250 proves this indecision. Until that fundamental identity is resolved, the stock will remain intensely vulnerable to structural noise like this lockup expiry.
So to summarize, the crash isn't a linear result of a single flaw, but a confluence of three major forces converging. The macro shift, which is the end of the high interest rate environment, the structural event of the impending December 2nd lockup supply shock, and the sentiment unwinding of massive retail speculation. The stock has to stabilize through that crucial $70 support and absorb the incoming supply before its fundamentals can truly dictate its long-term path.
And my position remains that investors really need to look past the headline earnings and focus on the non-fundamental forces dictating the current price action. CRCL's immediate future is being determined by market structure dynamics and institutional risk management. The high dark pool volume in the front running suggests that volatility is the primary certainty until that lockup supply is completely absorbed and that structural uncertainty is removed from the equation.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights. And see you in the next video.